Check, check. Okay. Gather around, come on in. Please join us for a rousing conversation about term sheets. All right. Welcome back to another session. We're glad that you're able to join us. We're going to talk about term sheets today. We've been advised to keep this pretty lively, so we're going to avoid just walking through line by line a term sheet and breaking things down. We're going to try to make this useful to all of you. For those in the back, please come on in. About to get started here. So my name is Dalton Wright. I'm a partner at Kickstart Fund, and I have the pleasure of moderating today's panel. Just by way of a quick introduction, so recently moved my family to Denver, originally from Utah. I've been investing in Utah for the past 14 years or so, but we've also been investing in Colorado over that time. So this is an extension of our commitment to the state that we're opening an office in Colorado, and have been very fortunate to have a warm welcome from all of you. A lot of the other fund managers have been beyond generous to introduce us to other entrepreneurs and other investors. So this is a remarkable ecosystem, and I'm very grateful to be here. So we have 3 people on stage here who have been in this ecosystem for a while, doing incredible things. And I'm going to hand the mic over to them for a second to introduce themselves. And we'll keep it pretty short, but the question is, tell us a little bit about who you are and what perspective you bring to the table on term sheets and early stage financings.
I'm PJ, one of the founders of Nomad. We guarantee rent for residential landlords and provide them software and services to help them be really good at what they do. We have raised through a Series A, so I've raised a number of rounds on different types of structures, price rounds, notes, so I think have a good perspective on the things that you can do as an entrepreneur to capitalize your business. Raise equity, have raised debt, so hopefully can bring a well-rounded perspective from a early stage perspective.
Great. Hi everyone, I'm Elle Bruno. I'm going to give actually some varied perspectives due to my background today. So for 17 years, I was a startup founder and operator. I helped build 3 venture-backed companies, either as a founder or an early employee, all in the consumer tech space, raised through a Series B. And then for the last 3 years, I was a managing director at Techstars Boulder, where I invested in pre-seed and seed companies. And most recently have taken on a role with JP Morgan, helping to build a group there called Tech and Disruptive Commerce, which banks early stage startups. So I would say my best experience is also as a founder, mostly what I'll be sharing with you today.
Hi, my name is Ed Messman, and I've been in the tech community here in Denver, Boulder for 25 years. Spent 13 years, first 13 years, 97 to 2008 on the structured finance side in venture, and issued and negotiated a lot of term sheets through 2 market cycles. And then spent the last 15 years on the startup side. So I've been with 4 startups now, all venture-backed, sold 3 of them, and involved with my 4th. So I've raised debt, I've raised equity, I've done acquisitions, and have both on the buy side and the sell side. So lots of term sheets. So happy to share my experience today.
All right, thank you, Ed. Well, I think for starters, I mean, one of the challenges with hosting or moderating a discussion like this for this audience is, we're not really aware of the level of understanding that everybody brings in as far as the terms of a term sheet. So, we could go into a lot of depth in certain areas that would be fairly interesting, and I think that we'll leave quite a room at the end for question and answer, so you can actually get some of your specific questions answered. But I think we'll open up just with a high-level discussion for those who are just barely getting into startup funding. The differences between an equity round, a convertible note, a SAFE. When you're raising money for your startup, eventually you're going to be having that conversation with your investor. Okay, how are we going to take the money into this company? What's the vehicle or the instrument that we're going to use to invest in the business? So I wanted to ask you, Al, just given, you've worked with so many companies that are taking their first round of funding, a lot of saves, very familiar with convertibles. How do you think about the right time to actually, when should you price your company and when should you take a convertible note? How do you think about that?
Sure. So thinking about pre-seed and seed startups, the most general investment tranches are via convertible notes and safes. And a safe is a simple agreement for future equity, which was started by a company called Y Combinator. Joking, love the competition. So YC built this template that's called a safe, and that is kind of, it came to market in 2013. Before that, it was really just convertible notes that people were looking at for pre-seed and seed rounds. The difference is that a convertible note is debt, and a safe is a future agreement. And I would say at its simplest terms, what makes a safe better to an early stage founder is that it's a pre-templated agreement. There aren't negotiable terms on it necessarily, and so you can close a round much faster with a safe. On a convertible note, you're looking at kind of two important data points there, one being interest and one being a discount. So they charge interest on a note, meaning if it doesn't convert into equity in the first, generally speaking, it's 2 years, you have to pay interest on that back to the investor. And then you also get a discount on the priced round. So I don't want to get too in the weeds here, but I would say the convertible note is debt, and there are terms to negotiate on that, which sometimes can slow down the actual investment process, where a safe is much speedier. And again, high level, but I'll leave it at that to start, if that works.
Great. And for PJ, I'd ask you then, so as you've raised money for your businesses, and in this case, Nomad, tell us about kind of the order of financings that you went through. And did you first take money on a safe? Did you price it immediately? How did you go about capitalizing the company?
Yeah, so in the sort of pre-seed days, the way I thought about raising money is that it was sort of a ever-evolving thing. It wasn't a round, it wasn't a process. It was you'd raise money from who you could, when you could. And so I ended up doing a few different safes with different caps on them. I did one convertible note. And so one learning as I look back on it is in those early days of fundraising, the ease of the safe was in some ways nice because you could get it signed with someone very quickly and not spend a lot of money on lawyers. But it was almost so easy that our cap table got relatively messy that by the time we were doing our first priced round, there was a lot of different safes, a lot of different convertible notes to juggle, and it made the first price round a little bit more expensive from a lawyer perspective and a little bit more complicated. So that was one trade-off. But the speed at which you can raise on a safe is really, really great. And in these early days, when you don't really know what your company's worth, it's kind of pointless to put a value on it. And so we found it much easier to raise using a safe in the early days. So would highly recommend it. They are typically pretty founder-friendly. So in this environment, you may find that investors are maybe less willing to do a safe and prefer to do a note instead. That's been my experience lately.
Yeah, we'll definitely spend some time talking about trends and market terms, but I certainly am seeing convertible notes coming back because that's what I'm proposing a lot of the time at this point. So I, as an investor in this market, prefer to be in a convertible note as opposed to a safe, and I'm seeing that maybe to the dismay of some founders who would prefer to raise on saves. But yeah, go ahead, Elle.
I was just going to add something to that it might be contextual for the group. If you think about the risk scale for an investor, highest risk would be a safe, and then a convertible note, and then a price round.
Yeah, and Ed, I would love to get your take. You mentioned that you've been through multiple market cycles. When you think about how you've seen investor behavior change over this time, I mean, safes are relatively new, so we can't point to multiple cycles of this. But what do you see? When you think about the incentives for an investor to either price a company, put a term sheet down for an equity price round, versus put a convertible note in with a discount and a cap. How do you think, any thoughts that you could share about the market dynamic?
Yeah, I think that I think it ebbs and flows based on where the market is. And I think there's two things: where the market is, how hot it is, how frothy it is. You know this. If you see a hot deal and you want to get in it and they're asking for a price round, you're probably going to do a price round term sheet. If they want a convertible note or a safe, you're probably going to try to wiggle your way in. The other thing is based on the momentum that you have with your business. So if you're hitting all these milestones and you've bootstrapped your business, then if you can get the price that you want for the valuation, you should probably do that. If you can't, you kick the can down the road and do a safe or do a convertible note. I will tell you, from the late 90s to when did Y Combinator create that?
2013.
2013. So from the late 90s to 2013, it was all convertible notes. And I think even in our deal, Dalton, we did convertible notes. Well, we did a convertible note that converted into a price round. So I see it all over the board right now. But really, if you think about your startup, if you have momentum and there's demand for your deal, then you're going to try to get a price round at the value you think you want. If there's no demand and you're scrapping for a transaction, then you're going to do whatever you need. That could be a convertible note, it could be a safe. And if you aren't getting the price that you want in the equity round, then you'll probably do a converter or safe so that you can kick the valuation conversation down the road.
Yeah, and I like how you put it, just as far as the risk to the investor, kind of safes, not a lot of protections, all the way down to price round where the terms are very defined. The only inverse of the risk with the convertible note and the price round is just, in some ways how the market, if it's going up or down, because, we have these experiences of having price companies, Web3 businesses in the, 21, and I would have rather been in a convertible note, right? So I paid a high price, and if I was in the note, I'm waiting for somebody else to now price it, and I get a discount on that price, right?
I always say, as investors, I compare us to weather people. Like, you can get your job wrong quite often and still have a job because you just have to get it right a few times. And it's like, if we knew what we knew then, right?
Yeah, exactly. Okay. So I think, let's focus then on price rounds, though, for a second. So I think a lot of entrepreneurs are going to be familiar with these convertible notes and saves. But when you actually are pricing around, you have a lead investor who's putting down a term sheet. And I think when people think term sheets, you have a term sheet that spells out the terms of a convertible note or a safe. But, really, oftentimes when I'm thinking giving a company a term sheet, it's a price round. So let's just talk for a second about convertible preferred. So preferred equity. So, that's a really important concept for everybody to understand who would be, negotiating a term sheet is, what does it mean to have preferred equity in your business? So if it's your first price round, it's all common stock typically. You've maybe raised money from investors who bought common, or you have some convertible notes out there that haven't yet converted into anything. So that's a jump ball. Anybody, want to take a stab at kind of, helping the audience get up to speed on kind of preferred stock?
Well, the preferred stock, the thing you got to be mindful of is that it's a price. So you're basically establishing a price point on the value of your company. And so we've all read headlines of companies that raise, rounds at billion-dollar valuations in the last 3 years. And many of those companies, you're probably reading the same headlines where they're raising money at sub-billion-dollar valuations. So there's, it goes both ways. If you can get it, and you feel like you can build your company into that valuation, you should take it. But you should also know that there's a lot of risk if you raise money at a high valuation that you may end up raising money at a lower valuation at some point in the future. But as an entrepreneur, you take that risk every time because you're betting on yourself to kind of build into that risk. So I think, I hope we get to it, but term sheets, valuation is just one component of the term sheet. There are a number of different elements of a term sheet that are equally as important from my perspective. And I think you can tell a lot from the investor, from the terms in the term sheet, not the least of which is valuation.
And I'm just going to add to that point, for the way I talk to founders about common versus preferred is the most important thing to note is that common gets diluted. And so it's worth a lot less in the long run than preferred. And I'll use the Techstars terms as an example. So Techstars takes 6% common equity stake in a company. What happens is that doesn't convert until your first priced round. So let's say you go out and you raise another round and you give 10% away of your company. That common stock will dilute by 10%. And then let's say you go and do your first priced round and you give away another 20%. That 6% dilutes by 20%. So by the time it converts, it's way less than that actual amount of 6%. So common is constantly diluting, whereas preferred does not until after that first round, that first priced round. And so it's not an apples to apples comparison when you're weighing, let's say you're weighing accelerator options, for example. It's really important to note that.
And preferred is what it sounds like. They typically get paid first. They sit on top of common in terms of sort of how they get paid in in the event of a liquidity event or a sale. A couple tactical pieces of advice for any founders out there. What we did was when we first incorporated the business, we actually issued ourselves founder preferred shares. About 10% of our shares we issued as founder preferred to give us the option to sell those into a round in the future. So some investors didn't like that we did that, but we were able to get through it. I find it nice to know that 10% of my shares are preferred and maybe a little bit more liquid, given that so much of my net worth is now tied up in this one venture. The other thing I'd say is you as a founder, it's your responsibility to protect, because you are a common shareholder yourself, it's your job to protect the interests of the common shareholders. And it's the preferred member on the board's job to protect the preferred members. Now, usually you work pretty collaboratively, but it's important to understand your role as a founder is really to increase the value of those common shares. That's how I think about it. And if you do that, the preferred shareholders benefit as a result.
Yeah, so to jump onto both of those points, typically a startup will go through, 3 priced rounds at least, generally? I mean, it depends, but
They're lucky.
Let's just say 3 priced rounds, if they exit, right, generally. So every round is a preferred round. And so there's this thing called the waterfall, which means that your last preferred round gets their money back first, then the next preferred round gets their money back, then the next preferred round gets their money back, and then common gets the leftovers.
Which is the employees, usually.
Right, exactly. So that's a really important thing to consider because your first 2 rounds are generally the most dilutive for the business. And if you're not careful with your first round, you could give up way too much equity. So all that waterfall ends up being very meaningful at the end when you transact.
And that's impacting a lot of businesses right now. A lot of businesses have raised more money than they're worth at the moment, which means that the preferred shareholders may get some money back, but the common shareholders may very well have stock worth $0. And so it's really important to get the valuation right as you go, because if you overdo it, your preferred shareholders could end up owning more of the company or all of the company relative to your common shareholders.
Yeah, and I would just add that preferred stock ultimately is convertible into common stock. So in the case of an IPO, and in the scenario where the company does really, really well, when you're selling your stock, you're selling it essentially as converted to common. It's before you get to that point where you have all these privileges and preferences associated with your preferred stock. So the liquidation priority, these are all called minority control provisions. And so in any term sheet you're negotiating, these investors, us, we're going to own less than 50% of the company. Rounds typically are diluted by 10 to 20%, but we still want to have a lot of influence in the business to protect our interest as investors. And so that's what these preferences are. So when you hear about preferred stock, it's all of these privileges and preferences that the investors have that ultimately, if the company does really well, you convert your stock to common and everybody gets their pro rata distribution. But when we talk about a term sheet here, there are going to be 2 main categories of terms that you're going to find in that sheet. There's going to be the economic terms and the control terms. So the economic terms, what percentage, who owns what, how much money went in, how is it distributed. But then there's the who can fire the CEO, who can appoint a board seat, who can block the sale of a company, those types of things. So a lot of the details of the term sheet are really focused on economics and control. So with that, I pass it back to the panelists here and ask the question, what are the most important things in a term sheet? When you're advising startups or as you're considering it for yourself, how do you rank order and what are the things that are kind of below your line and what are the things that you have to really focus on?
As I've matured as a founder, I've cared less and less about the economic terms of the term sheet. To me, it has to be table stakes. But if you get too cute on that, you can end up leaving a lot of other important things on the table. So to me, there's like a table stakes, what you need the company to be worth, what you want it valued at, and every dollar after that starts to become less and less meaningful. I think one piece of advice as you are negotiating a term sheet, leave your ego at the door. You see a lot of people on LinkedIn posting about their unicorn rounds, and that muddles the negotiation process. That muddles your decision making. So I think you should not be negotiating terms for vanity reasons. Is how I think about it. And it's the economic terms that usually make the LinkedIn headlines, right? And so figure out what sort of your table stakes are on economic terms, and then focus on the control terms. That's where the real sort of margin is made, one way or another, in my opinion.
Yeah, I mean, the other big terms in a term sheet are governance. So who's on the board? How many board seats do they want? Trying to think. I mean, I think some of the things like PJ, I didn't realize you had a founder preferred. That's actually pretty clever.
Oh, now you're going to be asking Kickstart for that.
I know. Dalton.
Sorry,
Dalton, it's
investors
coming.
in the room.
So that, I mean, that shows you the type of investors that you had, right? That they were willing to take that, right? Because they have empathy towards the founder, right? So that's just one element, I think, as you get into term sheets, when you're negotiating, you can kind of vet out who these investors are and do they really care about you as operators. I think the struggle, the tension is when you're a startup, you are hungry for money. Like if you're bootstrapping it or you just need equity, like when you see dollar signs and you see term sheet and you see whatever the number is, you're like, okay, you see dollar signs and you see cash in your bank, and sometimes you forget about the implications to the cap table. The cap table is a permanent thing, and it is very hard. You can do it, but it's very hard to change your cap table once you start, populating it with investors and priced rounds. So I think to PJ's point, like, the economics are one thing, but be mindful of all the other elements, governance being one of them, and those other elements, the preferred, what is it, founder preferred? I've got to get that in my vernacular.
I just want to double down on PJ's point about not being so concerned about the economics early, which is, I empathize, really hard to do, right? This is your baby. You started this company. You should own as much of it as you possibly could. But at the end of the day, you need the cash to build the business. And I oftentimes will do a math exercise with my founders on this. If you're raising $1 million on a $10 million cap versus a $12 million cap, and you're fighting back and forth over that, what is that realized value, assuming you raise 3 price rounds and sell for $1 billion at the end of the day? Literally nothing. Absolutely nothing. So, but that $12 million cap versus $10 million cap is so important to you in the beginning, and you lose out on opportunities if you don't leave your ego at the door and you don't do the math around that. So highly recommend just thinking that through as much as possible. And again, I empathize. I get it. It's your baby, but you got to grow your baby.
And totally agree. And one thing to add, the economic terms can change in future rounds. That's relatively easy, right? The valuation of the business changes. Some of the governance and control elements that are negotiated in your first term sheet sets the precedent for the next term sheet. And so you really set yourself up for failure if you're not focused on those terms early on, because the next round, the investor's gonna say, oh, well, you gave this person a board seat, I want one too. Or they have this liquidation preference, I want that too. So really important to understand the precedent that some of these things set for future rounds.
Yeah, I think that's so important. Yeah, the next round inherits the best terms of the prior round always. Yeah, and when we speak about these rounds, the seed round, the Series A, the Series B, we're talking about the next price equity round, right? So, just to keep the jargon complete here, each time you do one of these rounds, new valuation being established, but the terms, particularly on control and governance, tend to carry forward. Question around dilution then. So, rounds, there's a range of healthy dilution where you want your investors to have enough skin in the game for the company to matter to them. That they have some conviction that this could return their fund if this works. I matter as a portfolio company. On the other hand, the more you dilute, the maybe less incentive you have, the more your cap table becomes cluttered. And I'm actually right in the middle of advising one of our portfolio companies that's been accepted to Techstars. And this is a company that's raised a couple $1 million, kind of in that $10 million valuation range. They really want to do Techstars. Techstars is saying, you have to fix your cap table a little bit because investors, they see kind of money and dead weight on the cap table as owning more than 30%. So it's right now the company's 65% owned by the founders, employees, option pool, third owned by investors and others. So they're saying if you want to get into the program, go fix that, and we can't have you owning more than, we need the founders and the option pool management own 70% for us to be interested here. So that's a benchmark, a data point of like an accelerator. And I would love your thoughts on what you've seen pushback from investors that have previously funded a company that now wants to get into an accelerator. But this is an example. This is a down round essentially for a lower valuation than TechStars is coming in at, and they're also saying, oh, and you need to create more options and refresh the founders. So they have a strong point of view that, hey, we don't really care about the previous cap. Well, I shouldn't say that we don't care, but our focus is on the founders, making sure this cap table and this company is set up for success to be able to raise the next round. And that's a point of view on an appropriate level of dilution at the max for that stage of the game. And so this is a question that I'd like to explore. Just, how do you think about founder ownership and control of the business and investor ownership over subsequent rounds? And what are benchmarks you think of in your minds of appropriate dilution at the stages of your companies?
Yeah, I'll take that one. It definitely is a flag to investors if you've given away too much equity too early. And everything has a nuance, so that's just a generalization, but it certainly is the case. So you can easily pull the data out there on PitchBook. But what I've seen and kind of what we coach around is your first round, if you do an angel round, you generally give away 5 to 10% of your company there. When you move into a seed round, you're looking at about 20%. And then when you move into an A round, you're generally looking at 20 to 25%. I think the PitchBook data, if you pulled it, would certainly align with that to some degree. So that's what I would recommend as benchmarks. But the market's always changing.
It is. I think that sounds about right. Dalton, a question for you.
Yeah.
When your companies are negotiating term sheets, like how do you think about what they're negotiating? What signals or flags does it create when you issue a term sheet and all of a sudden they're negotiating 8 points?
Yeah. I think the points that you choose to negotiate reveal what you really intend to do with your company and what you care about as a founder. And so negotiations that are kind of like short-term focus, like I really care about what happens if I sell this company in the next year or two. Huge red flag. I'm like, hey, we know that the worst case scenario is this all goes to zero in the next 2 years. So, what I really care about is, are we going to go build a massive business as fast as we possibly can? And so I think anything that seems very short-term focused is very concerned. Anything that feels very transactional, like treating me just as money. And I know that in some ways I do feel like I am just money. But we're also people that care about how we're allocating our money. So I feel like kind of sales tricks of constantly dropping names of the other founders that are or the investors that they're talking to. I get that's part of the leverage and gamesmanship here, but being too kind of transactional in the negotiation style is a red flag. I think demonstrating that you're going to be really, really stingy in how you try to build your company can be a red flag. I really value founders valuing their equity. It's like, this is very, very going to be very, very valuable if it works out. At the same time, understanding that in order to go build a very valuable company, you have to recruit world-class talent, that you have to attract them away from the best jobs, opportunities in the world potentially, to go take a chance on your, rinky-dink startup that nobody's heard of yet. So if you can show that you're going to be able to, you're thinking about how to get this done in a way that's not so just greedy, in how you're approaching this. So I think those are some of the red flags that I see. I think a bunch of red lines coming back from the, lawyers signaling that this is going to be a very difficult negotiation. Those are some of the things I see as well. But
don't be afraid to push back as a founder if you need to. I think on one hand, I think most investors respect if you come back with red lines. Maybe if you're getting into the nitty-gritty and losing the forest for the trees, that's one thing. But you should absolutely be negotiating your term sheet. Very infrequently in my opinion, should you be signing the first term sheet given to you.
100%, yeah. And you should also have a lawyer at your side, not in the conversation with the VC. Don't bring your lawyer to the meetings, but, in terms of, reviewing the docs and actually advising you, it's a lot more expensive to hire counsel that hasn't done it before. So have counsel that's actually represented venture-backed startups before. It'll be much smoother. It costs you a little bit more probably than your neighbor lawyer or whatever. But yes, thank you for emphasizing that, PJ. You have to cover your interests and get the best deal for the company. But at the same time, like, I would say getting into, like negotiating things that don't actually matter, like the corner case stuff. It's like, to get to a deal, both of us have to be willing to throw away 20% of the stuff that's not that important to us, just to look past. It's okay, that's whatever. I prefer this, you prefer that. But to get the core things right, that has to be meeting their minds, and that has to demonstrate goodwill, collaboration, and alignment. And so, Ed, to your point, it's just like, this is, you're signing up for a long journey together. You have to live with it. And so, the way that you conduct the negotiation, is also, communicates how you're going to be to work with for 10 years. And so, press back, be strong, show that you're a strong leader that's, fighting for the interests of your company, and that you're savvy and clever in how you do that, and you have the best advice at your side. But part of that includes being able to see past the weeds, to get to a deal.
And I think, I said this earlier, but not getting too cute with your dilution. I think it's important. It's your company. There are other ways to refresh your shares later. Everyone wants you as a founder to be bought into this business. It's in your investors' best interest. It's in yours. And so in a future round, you can issue yourself shares that vest just like an employee's would if you feel like you need to top off some equity. So that's something I know a lot of founders do. And then on the lawyer front, get a good lawyer early who does this often with other venture-backed businesses, not just because the term sheet process and negotiation will be faster, but they have data. They understand what market is. They understand, for a company of your size in this industry, what valuation you should be demanding. They have a lot of data on when you should be giving up board seats. So use them for more than the negotiation. Use them to help understand what the market is. A lot of these great law firms actually will offer kind of free counsel in the early days of company building in exchange for payment at your first round. So it's really never too early to seek out awesome counsel.
So I think just putting a bow on all the thoughts we've just shared, I think it's safe to say what we're all saying here is it's more important to focus on governance than unit economics in the long run. Is that fair to say, to some degree?
I think so. I mean, I was going to kind of, to your point, Dalton, everyone's got to be motivated. Like, your investors have to feel like, they're motivated. Certainly the entrepreneurs are motivated. But I've always viewed it as a partnership. Like, your investors are partners, and you should treat them that way. If you're considering to bring them onto your cap table, they should be the partners in good times and bad times. It's like a marriage. And I think the more transparent you are on why you're negotiating the things that you're negotiating, it helps them understand how you tick and what motivates you. But at the end of the day, they've got to be equally motivated to advocate on your behalf, because at some point in the future, you're going to raise another round of financing, and they have to go back to their partners and get approval for their pro rata investment in the next round and help introduce you to new investors. So it is really a partnership.
Yeah, there's an entrepreneur in Utah that uses this phrase that I like, that your cap table is your culture in a lot of ways. We do all this talk of culture and everything, but it's like, who's behind, these names and line items on your cap table, and who has the alignment? Who cares about this thing? Who stands to benefit? Who is, putting in the most effort to see this thing be successful? And that story can, in part, be told by, who's on the cap table. And so it's hard for me to draw a hard line between like governance, control, economic terms when they kind of bleed into each other, where, it's like, the ownership structures represent governance in the company as well. So I do think that all these things matter, but I think really what we're highlighting is that there will be changes to the economic terms as you go, as the company performs, and there's a rational valuation ascribed to your stock. But all these other things that relate to your board governance and the people that you actually have to answer to as a founder, and who stands to benefit from the success of the business, that's is held within the cap table in a lot of ways. Go ahead, Nell.
And I would say spend as much time with your potential investors as you possibly can, and spend time with them in the wild. It's really important to see what your potential investors act like when they're ordering from a waiter or waitress, how they treat others in public. I know it sounds like a simple thing, but to everybody's point, you're in this for 10 years with these investors, and you really need to get to know them as best you can as humans as well as business people. And a cautionary tale on my end, because we raised a Series A when I was the president of a company called Luxury Garage Sale. We took on a lead investor that we just were not aligned with. It didn't feel right from the beginning. And it essentially, the short story is, ended up being the demise of the business. And so I always share that story because we did not do enough diligence on our end to get to know those investors well.
And some diligence that I have done in the past that I found helpful, talk to other founders who the investor has invested in, get their thoughts. What is it like working with them? Even talking to an LP of the investor could be interesting to understand sort of what their thesis is as a fund. Are they going to be able to raise money again in the future? Getting an investor on the cap table who then can't reinvest at some point in the future because they can't raise again is not great either, so talk to an LP. I like to ask, how far through your fund are you investing? So are you halfway through the fund? Are you just starting? Are you at the end of your fund? What fund number is this? How much, what's your track record like as an investor? Are you going to be around for me in 5 years when I need a capital infusion? And so I think that diligence is really, really important. And don't be bashful. Like I share the term sheet with other founders to get their thoughts on whether it's fair or not. It's not something you necessarily have to hold close to your chest.
Okay, I want to be mindful of time here. How are we doing? Let's see, we're at 2:07. Okay, so I'd say let's go ahead, open it up to audience. So I bet some of you have some questions that you'd really like to ask the panelists here. So go ahead.
I can repeat it. There you go.
Two-part question. You were talking about getting the governance right. That sounds like great advice. I'm not exactly sure what it means. And then second part, what do you guys think about equity management platforms like Carta, and how does that fit in?
Yes, on Carta. If you've had to run a cap table in Excel, it is a nightmare. So I would definitely highly recommend, and all your VCs and investors will have discounts to those platforms, so it's like a no-brainer. Plus, it helps you do kind of assumptions on different fundraisers. So that was a yes. And then governance is really who makes decisions on behalf of the company. So if there's sticky issues, how does that vote happen? And that's the board seats. And so there's some detail behind that, but generally speaking, the board controls the decisions of the company. So how you establish that early on is really important. And as PJ said earlier, it's precedent. So you give a board seat for your early stage investor, then the next investor wants 1 or 2 board seats, and before you know it, you've got competing demands for governance of the business. So in the early days, I think it's really important that you be really mindful of who is on the board, because you're still in the formative years of the business. You think you know what the business is going to do, but I guarantee you that in 12 months it's going to be a little different, and 12 months after that it's going to be maybe largely different. So just making sure you've got good alignment on the board is really, from my perspective, governance.
And I'd echo, Carta's great. We have our lawyers manage our Carta to make sure it's, because you could very easily input things incorrectly. I don't know if you guys do that or not. And then on the board thing, I think the mental model I have is that at the seed, you give away 1 board, so that when you're founded, you've got how many founders you have, you kind of determine. For us, we had 2 board seats, me and my co-founder. At the seed, we gave up a board seat to the lead of the seed. And then at the A, we actually didn't give away a board seat, which in some ways was great because we still control the board. But on the other hand, the Series A investor did not take a board seat, and so they're a little less involved than I'd like them to be. And so in some ways, actually giving a board seat can be a good thing because you actually get that investor, excited about the business, engaged. And so it's not necessarily a bad thing to give up a board seat. But the way I think about it, at the B, we'll probably have 5 board seats, 2 common, 2 preferred, and then an independent. So that's sort of my mental model for growing the board.
If there are two equal co-founders, do you have any advice of how to set up the business, both for like governance and economics? Because I know there's a lot of different ways to do it.
51-49. I highly recommend someone has majority ownership.
And people over-rotate on who's often one of the co-founders is the one that had the idea initially. You're both embarking on this together. I think assigning a premium for that idea, people way overthink. For me, the premium for an idea is like 3 to 5%. A lot of people think it should be higher, but in the early stages of company building, you're going to be off to the races together, and you really shouldn't think too hard on that front.
I think to Elle's point, I've been involved in companies where it's been 50-50, and then a year later, you're like, well, doesn't feel right, and so then that's a tough conversation to have, to kind of renegotiate equity. Not impossible, but kind of tricky.
But make sure your founder shares are vesting just like an employee. So if one founder leaves after a year, they're not walking away with 50% of the business. So I'd recommend even founders be on a vesting schedule.
Yeah, and that tends to be one of the high conflict items in a term sheet between founders and investors is when we put terms down, oftentimes like we're betting on the people, of course, at the seed stage, and we want to know that they're really aligned to go the distance with us because we're not going to be able to sell our stock for years to come. So, you look at this founding team and they've been maybe at the business for a couple of years, and we come in as the first check and we say, hey, we want to revest the shares that you already have vested. That's where, and this is a negotiation back and forth, but we're saying, yeah, we want to, subject what you already own. It's your business, and this is why it's frustrating to founders. They're like, this is my company, I've been building it, and you're telling me that the 50% that I've already vested, I have to turn around and revest. And the reason is that if a founder walks out the door after we invest, say there's equal co-founders, one of them leaves, it's not for them, it's just not working out. You have a quarter of your business or a third of your business, 40% of your business that now is in the hands of somebody who no longer is actually working for the company. And so, yes, I think that's so important that if you have co-founders and you're not on a vesting schedule, you can count on investors, VCs, eventually putting that vesting schedule in place. But it's better for you to proactively do it because things don't work out a lot of times, and you can actually damage your cap table to the point of difficult, if not impossible, repair if you have dead weight, departed co-founders. And so everybody, no matter how critical they think they are at those early days, they have to go the distance. It's not just about an idea founding, it's about now going and executing.
So how do you transition from a solo founder with a board of advisor that is pro bono, it's your smarter colleague, older professor, to a board that has voting right and governance? How that transition happens?
The transition for your advisor and your
yes.
and a board?
How do you go from an advisor that is your support team, your fan, to the governance that has voting rights?
Yeah, usually it's probably established when you raise capital. And typically you're going to have an odd number of a board, 3, 5, 7. And in those early days, if you felt like that advisor was someone that you wanted on the board, they could be a candidate if there's a spot open. Otherwise, it's going to be your capital partners and the operators of the business that are generally on the board, because those are the ones that are making a lot of the corporate decisions.
Yeah, and just a reminder that, the board advisor does not have voting shares. A board member will. So do you want them to be voting when you decide if you're going to sell your company to OpenAI? Like, you have to think about those scenarios. And oftentimes, companies outgrow board advisors. It is not uncommon to see that happen. So again, just, if you don't have to pull that lever from advisor to board member for a while, I wouldn't, because you're getting to know their value. And board advisor value tends to drift off a bit over time as well. And so 2 years into a board advisor relationship, there's oftentimes, okay, they've given me everything they can at this point. It's time for me to move on to an expert in X, Y, and Z, or someone who can make these introductions.
Can you provide more context on what control terms look like for acquisition? And then also, like, if you're in an industry where acquisition might be fairly common in the $20, $50 million valuation range, is it like a bad idea to take pre-seed or seed money when you might be setting yourself up for conflict with your investors?
I mean, I definitely have some thoughts on that, but I don't want to, as a moderator. Go ahead, BJ.
I think if you think acquisition is a real likely outcome in the near term, you definitely want to spend even more time on the control provisions. The things I think about are like liquidity preference. So at what, right? If a dollar invests a dollar today and you sell, do they get a dollar tomorrow? Do they get $2 tomorrow? $3? I think that's the thing I've always negotiated hardest on. None of our term sheets we've signed have ever had a liquidity preference other than a 1x. So that's a really important one. We're negotiating a note right now for kind of an extension. And in the note, the first iteration of the note had a 2x change of control provision that said that if we sold the business within the terms of the note, investors would get paid 2 times back on the note first. And we cut that. We've redlined that out. That was important. And so, yeah, especially if you're thinking about acquisition in the future, you definitely want to make sure you're thinking about those things. You know, what percentage of the board has to approve an acquisition is another, important one. I'm probably missing a lot, but really important, I think, in your case, it sounds like, to think hard about those.
Yeah, and I think, you're already identifying some alignment challenges. So if you're thinking about what votes would I have to have in order to sell it, there's already this question of, why is it even a question? Shouldn't the investors that make that decision be excited about selling the business if they're the ones who have the power to vote on it? And so I think you're asking the right question around, does a seed fund want to invest in a company that could sell for $50 million? And the answer for most seed funds is probably not. Although there are some funds that would say, that's a perfectly fine outcome for a single check. But most funds are trying to return their entire fund. And so if you're talking to smaller funds, they're going to do the quick math saying, if I have success with this investment, could that check return all of the capital for that fund that I'm deploying? And so you're looking for these outliers. So if you already know that the 50 million is kind of where you cap out, then most seed funds, are having to underwrite to like at least a $250 to $500 million outcome. And the bigger you get, you're talking about hunting for billion-dollar companies.
Are there companies that try to raise money that might not be a corporation and maybe they're an LLC? How does that process differ, or is that even something that really happens out there?
If you're raising venture, become a corporation, I think would be my advice. I could be wrong. Most investors won't write a check into an LLC because the governance is a lot harder to control.
Yes, I've also seen LLCs get funded, but very rarely. Yeah, most of them are C corps.
Hey,
And then this woman in the yellow who's had her hand up for.
I was wondering if you guys could talk more about liquidation preferences and specifically participation on the investor side. How do you all think about it?
So just for the audience, like participating liquidation preference. So there's a liquidation preference means you get your money out first, up to 1x is the standard. But then there's this detail around participation. So do I get my money out first, and then I also get to take my percentage ownership distribution of everything else that goes after that? Is that the question that you're asking? Yeah, so that's called participating preferred. So there's a liquidation preference and then participating preferred. And the question is, how common is participation right now? In investor favorable markets, we used to put down, we regularly include participating preferred in our term sheets. As the market heated up and terms became more consistent with Bay Area terms, we got rid of participation on the liquidation preference, and it was just 1x non-participating. Right now, it's a way to bridge a gap between valuation conversations. So if the investors don't really like the valuation where you're coming in at, a way to bridge that gap is to do like a participating liquidation preference. So it's a little more interesting to the investors. So you're seeing these creep back up, like maybe 20% or so of price rounds have some form of participation right now would be my guess.
For those of you lost with some of these terms are purposely confusing because the information asymmetry benefits investors typically. So get yourself good counsel. Don't be intimidated by these terms that you would never use in normal life.
Although I would say that's changing right? I know you guys at Kickstart and locally the Foundry guys. They do a pretty good job of trying to demystify a lot of those terms, and it's it's to everyone's best interest, so that everyone knows what you're getting into and what are the important things to negotiate.
Yeah, and for what it's worth, when I negotiate a term sheet with a first-time founder, before we're even talking terms, I'm walking through like a straw man term sheet, just saying, let's talk about what we think a market term sheet looks like, and let's talk about this in the abstract before we apply it to your company.
Yeah, and this is a good time to plug the book Venture Deals. If you have not read it, it is the most excellent resource for first-time founders looking to raise money. So highly recommend it.
They're going to get to me.
Yay,
Who's first?
we did it.
Oh, is it me? It's me. So in any deal, contract, sales deal, if we get to the paper and that's when we start to negotiate, it feels very much not like a mutually beneficial experience. So when is the appropriate time to really start negotiating these terms? Because it doesn't really feel like you want to do that before you get the term sheet and then you have to send back a bunch of red lines. So what's that appropriate experience?
I've never pre-negotiated terms before a term sheet. I mean, generally you're trying to create a compelling reason for them to get excited about what you're doing, right? And their excitement or lack thereof is going to be reflected in the term sheet they give you, right? And so that's what I mean. You can tell a lot about how they view your business or the opportunity of the business based on the initial set of terms. That could be in valuation, that could be in governance, that could be in liquidation preferences, a variety of different things. And I think there's a lot of personality in that first look.
Agreed, absolutely. Some of that stuff will come up organically in conversation along the way, but one thing I would recommend is don't immediately go into investor call and say, we're raising $1 million on a $12 million market cap, right? You're playing all of your cards there. So even the market cap conversation or the valuation conversation will likely happen a bit more organically, and I wouldn't put that in a deck. You're kind of putting yourself in a corner when you do that as well. So yeah, wait to negotiate the terms. Agreed, once the term sheet comes to play.
The only caveat I'd say to that is be really buttoned up with how much money you think you need to raise. If you're just throwing out a random number, you don't have a lot of leverage. If you have really done the work to say, this is how much money we need to get to this milestone, it's really hard for an investor to say to you, no, you don't actually need that much. In fact, often they'll say, actually, you should probably double that number because it's always twice as hard as you think. So like, at least do the work to understand what you need to raise. And then if you signal what you need to raise to the investor, you've kind of almost anchored them to a valuation, because the mental math, if you divide that number by 20%, that gets you to the valuation. And so you've almost anchored the investor at that point to a valuation without actually asking for the valuation, if that makes sense.
Such a good point. And sorry, one more thing to add to that. Also, another don't say we're raising $2 million to hire 5 software engineers. They want to know what hiring those 5 software engineers will result in. What milestone will you hit? And they want to see you do the bottoms up math behind that as well. So be as pointed as you possibly can on use of funds and their results.
So to the point about the cap table is your culture, how do you think you should pay attention to the percentage of the equity as it relates to the functional units of the business? So, your engineers are roughly, for the common stocks, 30%, your sales org, 40%. What do you think that should generally look like, and how uniform does that look? And does that tend to align with the value that you're getting from the investors that you're bringing on? Like, which ones are offering you access to different types of talent? Do you think that's a good heuristic to get alignment on?
I'd use your investors as a resource for how much to give away to individual functions. They have much better data than you do. I also use, I don't know if you guys have used this, but Carta has a really great total comp tool now that actually helps you benchmark for the stage of business you are and in the geography you're in. It helps you understand what comp bands, both cash and equity, are appropriate. So you don't have to reinvent the wheel. Carta's a really good resource. Your investors will be a good resource for that as well.
Yeah, outside of the founders, most companies generally carve out a 10% employee option pool to be distributed amongst all of the employees. 10 to 12 to 15. I've seen it get bigger here and there, but for the most part, around that much in total.
Depends on your business. If you,
I think, yeah, it depends on your business. Like who's going to be cranking the hardest over the next two, really between today and the next round of funding, because you can always top them off. That's how you kind of look at the equity piece, and you want to keep them motivated, like motivation from your investor, motivation for you as your CEO founder, and then motivation for your team. Why is it interesting for them to, not go work for Google or Facebook or, XYZ company down the street?
One quick story. I was the head of sales for a company called Trunk Club back in 2013, and we were doing $100 million in revenue. We'd only raised $7 million in total funding. Every single employee in that company, all 1,200, had a slice of equity, even the janitor. And I still believe to this day that's how this business was able to grow so quickly and do so well with very little investment brought on. And it was the second largest e-commerce acquisition of all time at the time when we got acquired.
You gave helpful benchmarks on dilution for each raise. Can you do the same for cap table at each stage, what you would consider crowded or not, number one? And then number two, if someone does fall into what you'd consider a crowded cap table, what are justifications for that you find compelling, given that early stage companies especially, like you said, getting money is the most important thing, and if you can close 8 25K checks instead of one 200K check, kind of how to think about that.
When you say crowded, are you saying the number of investors?
Number of lines, yeah.
Yeah. Well, I think I've learned this the hard way, because you have to manage all those investors as a founder, which means phone calls on every round, status updates when they send you emails, and you will get them. So you just got to be mindful of the investors, the number of investors you bring on, and how much you're going to have to manage them, because you will have to manage them.
And those small investors typically are the ones that are asking the most questions, in my experience. One thing I had a group of small investors do is I sort of required that they invest as a part of a syndicate, and so I had a lead investor who kind of was responsible for herding all of the cats so that you didn't have to. And then there's like social pressure for them to all get their money in. So a syndicate is really powerful in that way. And then you can just give the syndicate manager the update versus everybody else. And I've set the expectation with those syndicates that I will only do, I'll talk to everybody, but really the expectation is I'm only going to give the manager the quarterly update.
I think, I would just add one little thought here, which is, I have seen the case where more investors is better. And that is, the singular example I have of that is a controversial studio that I've been involved with called Angel Studios, which is, distributing films outside of the Hollywood distribution networks. And they've done it through crowdfunding. So they crowdfund for the distribution of the projects. In this case, our community of investors is one of the strongest assets that we have. So it depends on how you see the names on that cap table. And I wouldn't say it's always just one direction, though. Take more money from fewer. Generally, that's the case for all these reasons that we discussed. But depending on the type of business that you're building, your investor and cap table may be part of your competitive advantage.
And some, these crowdfunding platforms, they do make it easy for you to communicate back to all your investors. So you can do status updates, like how are we doing? And it goes out to your 200, 300 investors. So that's changed as well, which makes it a little bit easier.
I think we have time for maybe one more here. This is the last minute that we've got. Thank you.
I hope I can take you out on a good note. I also just really briefly wanted to thank you for the rich and deep information you're providing. And Carta, I'm not plugging them, I don't represent them, but they're a great source of information too. I want you guys to take a minute and say it's 10 years from now. We have a lot of different kinds of funding mechanisms that are starting to come into their own, revenue-based financing, whatever it is, whether it's crowdsourcing or what. I'd love for you guys to just really briefly, what do you think is going to happen to cap tables and the process? Zero, nothing will happen to them. It'll all be deal by deal, or will there be any kind of seismic changes? Thanks. A little look into the future. This is where you get to speculate.
That's a great question to go on.
I can tell what I would like it to look like. I don't know if it will look this way, but the thing I hate most about this whole process is writing checks to attorneys. That is the worst thing. You've just closed this awesome round. It's so exciting, and then a month later you get a bill for $150,000, and it is so frustrating, right? That could be an entire month's worth of burn. So I'm hoping we can move to a world where all of these forms are standardized, that doing a priced round is as easy as doing a SAFE, that there are just down the fairway terms that everyone agrees on, neither too founder friendly or too investor friendly, and they're standardized. I think Gavin at Kickstart, he's working kind of on nationally with the venture community to do this, but standard forms, standard terms, and legal fees that are much, much lower.
Yeah, I would say that's changed, and I think that's even, Kickstart, and we work with First Mile Ventures. They recommended the Y Combinator seed stage term sheet and closing docs, and literally copy, paste, email, and I think we ended up spending $15,000 in legal fees, which I thought was still high, but it is getting better.
I hope in 10 years, at least 50% of founders that are funded are either Black, brown, or female founders.
And I hope that access to equity is, much more broadly granted, and earned. And so I see cap tables and the way companies use their equity changing over time. So, right now it's just, you have the concept of an option pool, and you can hire your employees with it. You can give some shares to advisors. But that concept, I think is due for an upgrade, which is, there's a lot more you can do with your equity if you can build really powerful communities around what you're trying to accomplish. And so I see kind of crowdfunding and crowd distribution of technologies continuing to grow. I don't know how that's going to transform what we do as venture capitalists entirely, but my hope for the future is that it becomes much easier for accredited investors, unaccredited investors, anybody who wants to roll up their sleeves and contribute to value creation in a startup to be able to gain access to that cap table. Please join me in thanking the panelists for this discussion.